Good evening, sir. Good evening, sir.
You're welcome, sir.
Yeah, thank you, sir. Yeah, thank you. Good evening, all. Good evening. I have like seven students online. Okay, good evening, all. My name is Taiwo, and I will be taking Ibrahim Taiwo. My name is Taiwo once again. I will be taking your advanced taxations alongside with Mr. Chima. Yeah, that took you yesterday. So please, I will crave your indulgence to pay attention. So as we'll be a bit, we'll have to speed up a bit, but at least we'll moderate it because we don't really have time anyway. Now let's quickly go straight to the. Give me 2 minutes. Let me just share what I have here, please. Okay. Welcome once again. As I said earlier, that my name is Taiwo. Now, so what we'll be doing today, we'll be taking part of advanced taxations, part of some of the topics there. And I know you know the rules. You have to abide by the rules that you should moderate, you should gauge whatever you'll be saying. I mean, we are professionals. And also, everybody will be muted. You just be listening. If you have any question, you can use the chat button to talk to us. I get what I'm saying. Now, if you shout me via the chat button, I will attend to your questions. And if I cannot attend to it now, we'll actually refer it to the WhatsApp platform. Thank you for your understanding. So let us continue. Now, today, I will be talking about these 4 topics. You know, we have like 20 topics in your syllabus. I mean, about 2021 or thereabout. Now, some of these topics I actually picked some of these topics from what you have in your syllabus. So the one we'll be dealing with was 1, base erosion and profit shifting. This happens to be a new topic in your syllabus. BEPS, base erosion and profit shifting. The second one is tax audit and investigations. And the third one is transfer pricing. And the fourth one is merger and acquisitions. I'm quite sure that, one or two of these will obviously come out in your exam. So let's start. Let me start from the first one, base erosion and profit shifting. Now, this will be the first thing I will be talking about here. Now, it's a topic. Now, we will take it like a lecture topic, revision class, lecture, because they are theoreticals I'm taking today, 4 of them. So pray we'll be able to handle it and finish it today, but we don't have time. Now, let's start with the base erosion and profit shifting. Now, from the word base erosion and profit shifting, now, what do we mean by this? There are 2 words there. This is base erosion, and this is profit shifting. They call it BEPS. BEPS, base erosion and profit shifting. Assuming you get into the exam next month, and you're able to see this topic, base erosion and profit shifting. What will you write? Now, let us start by first explaining what's base erosion and profit shifting, then I'll now look at the illustrations. Now, base erosions and profit shifting are 2 words, they have 2 things in it. The first one is base erosion, and the second one is profit shifting. When we say you are eroding the base, it simply means that you are technically reducing your profit for the purpose of what? Of reducing your tax liabilities. Look at it, base, tax base. Tax base is what you are paying tax on. Let's say your company income tax now, your income that you make in your company. That's what's your base. I guess that's what you want to tax. And when they say erosion, when you erode the base, you are trying to reduce that profit. I guess what I'm saying now. You want to reduce it for the sole aim of not wanting to pay tax. So what do we mean by this now? It simply means that there are some organizations that their focus is that they will be looking at at all costs, reducing the profit they are making in the organizations. Reducing how much profit they declare to the tax authority. I get what I'm saying now. And after reducing it, it means that tax authority will have no any excuse than to tax them based on what they present to them. It simply means that that company is doing what they call base erosion. That's when you are trying to reduce the profit of the company for the purpose of reducing tax liability. Now, the second one is profit shifting. Profit shifting aspect of it is all about you wanting to move profit from one region to another region. Take, for instance, a company that is having a division in another country. Let's say you're having in Nigeria and it's having in South Africa. Now, if you realize that Nigerian government, the tax rate in Nigeria is on the high side, definitely it will find a way of wanting to move the profit they make in Nigeria to the South Africa, so that instead of them paying tax in Nigeria, the tax will eventually be paid in South Africa. Now, the techniques of doing that, they have a technique they used to do that to move that profit. I get what I'm saying now. If you are doing that, you are doing profit shifting. It means that in the exam, if the examiner now put to you and say BEPS, base erosion and profit shifting, the first thing you need to know is that there are two things. Base erosion, you are trying to use your tax planning technique to reduce your to reduce your taxable profit, so that tax liability will be on the lower I mean, it will be reduced. Now, the second one is is profit shifting. That is a situation where you are trying to move a profit that you make in a region. I guess what I'm saying now, because of the tax regime in that region, you are trying to move the profit to another region. I guess what I'm saying now, in which they have a lower tax regime. So that instead of you paying tax in the first region, you will not pay it, and what the tax is supposed to be paid in the first region, you now be taken to the second region where we have lower tax regime. That is what is what we mean by profit shifting. So in the exam, you should be able to explain it. Let's look at the illustrations, please. Now, it means that in the illustration, they said base erosion and profit shifting. And these are questions, examinable questions. Please don't underrate all what we are discussing today. They are examinable questions, because these are new topics to your syllabus, and these questions are what they have at the back of your pack. I guess what I'm saying, that they said are examinable. Therefore, as we are looking at PPT, commencement, pioneer, and so on, all these computational course, topics, also look at this area. Don't overlook them. Now, illustration 1, base erosion and profit shifting are advanced tax avoidance strategies, usually adopted by multinational enterprises. You are required to discuss any 4 techniques that could be used to achieve these tax avoidance strategies by multinationals. Now, it simply means that the culprits in this base erosion and profit shifting, those people that actually indulge in this activity, I guess are the multinationals. And I say when I say multinationals, they are organizations that are having they're having different divisions across the globe. They're having their operation in different countries of the world. I guess what I'm saying now. That simply means that kind of organizations, it's easier for them to carry out what they call base erosion and profit shifting. So it means that in the examination, you should be able to tell them, as you are writing, that the multinationals are the culprits that are really indulge in these tax avoidance activities of base erosion and profit shifting, and they have their technique in your pack. There are 4 techniques that your pack identifies. If the examiner is coming from this angle of the question of the syllabus, in this next exam, they will ask you to explain those 4 techniques as highlighted in their pack. Let's look at the techniques, please. Now, solutions to those techniques. Now, the following are the techniques usually adopted by the multinational enterprises to achieve base erosion and profit shifting tax avoidance strategies. Now, please note that the BEPS mostly are classified as tax avoidance techniques as carried out by multinationals. And I know you have an idea of what we mean by tax avoidance as against tax evasions. Tax avoidance is when you are technically looking at the loopholes in the tax laws of the country, and you are now using that loopholes to your advantage. You want to pay the minimum amount of tax possible. Are you getting me? By exploring the loopholes of the organization. So the BEPS are mostly classified as as a tax avoidance techniques. You now want to see, you need to now pay attention to those techniques now, so that when you are explaining this in the exam, you'll be able to have more to what to write. Now, the first thing you need to work, that the multinational use, the techniques they use in carrying out the base erosion and profit shifting is trademark and technology licensing transfer pricing. Now, when we say trademark and technology licensing and transfer pricing, now it's more of, if you have a multinationals, and those multinationals that are operating in different countries, now they will designate a particular division. I mean, out of all let's say for instance, they are having about 5 divisions that spread across 5 countries. Now, maybe Nigeria, US, UK, and Zimbabwe, and Uganda. Now, they can now identify the division in Uganda, and now say that division in Uganda will be the division that will be handling the work, the trademark, the franchise, the licensing, the trademark, the patent, the brand, everything that relates to the brand, to the patent, to the trademark of the organization. We now say that divisions of that company that reside in Uganda will be the one that will be handling the trademark and all that on behalf of the other divisions. I hope you're getting me now. It simply means that the cost incurred in managing that on behalf of the company, will have to be spread across other companies in the group. I hope I get what I'm saying. Now, let's say, for instance, the cost they incur in a particular year by Uganda now, by the one in Uganda, say for instance, they incur maybe 100 million on the management of the trademark, of the patent, of the organization, of the brand, of the organization. Now, you know very well that cost will have to be shared among the five divisions that spread across the 5 countries. How would they share it? Now, the multinational can now decide to arbitrarily, listen to the analysis, they can now arbitrarily apportion that cost to the division across the globe in such a way that they will achieve their selfish interest. When they say arbitrarily, let's say for instance, the amount out of that cost that's supposed to be apportioned to the Nigerian division, maybe supposed to be 100 million, let's assume. Out of the whole of, maybe supposed to be 10 million out of the 100 million. Now, because that company will not want to pay tax in Nigeria, or want to pay the least possible tax they can ever get in Nigeria, what would they do? Instead of them apportioning 10 million out of that cost, appropriately, that's actually meant for Nigerian division, what would they do? They would jack it up to maybe 40 million. Which simply means that what? They deliberately add 30 million to that 10 million to make it 40 million. So that amount will now be a cost to the division in Nigeria. If it's a cost to the division in Nigeria, what happens to the profit? The profit should drop in Nigeria. What happens to the tax liability? The tax liability will drop. I hope you get what I'm saying now. That simply means that company is trying to use his trademark, his license, his patent, his brand. I get what I'm saying now, because they incur from those things to what? So reducing the liability in the tax liability in the country of choice. I get what I'm saying now. That is enough. That is what they mean by what? Base erosion. It means that they have eroded the profits in Nigeria, which means that the tax liability in Nigeria will also be on the decline. I guess what I'm saying now. Look at it. It's a trademark and technology licensing / transfer pricing. Look at what they put in your pack. They said managing the group's trademark, design, and patent through an entity that applies a lower tax rate to intellectual property, then charging group companies royalty on the use of the brand. They will be charging the companies, I get what I'm saying, on the use of that brand, but the way they will charge they will be arbitrary. It will be uneven. It will not be it will not justify the cost that should be the usage of the brand by each of the divisions based on what the company is looking at achieving. That simply means that multinational can use these techniques of trademark apportionment of costs, to reduce the tax liability in the country of choice. I hope I get what I'm saying now. That is what we call trademark and technology licensing as a way of reducing the tax liability of multinationals. Now, the second part, which you need to explain to the examiner as a technique of what of carrying out the what the BEPF is what is thin capitalizations. Now you want to ask me, I know you'll be asking me that. You want to ask me that when we say thin capitalization, what do you mean by thin capitalization? When they say a company is thinly capitalized, that means that that company is geared. I hope you're getting me now. I know you must have taken care of this in your what in your SFM. When they say a company is geared, is highly geared, that means that that company is what is having high proportion of debt capital in the total capital structure of the firm. It means that when you're having more debt that you're using to run the business as against the equity, then you say you are highly geared. In tax parlance, they will say you are thinly capitalized. So in the exam, if you are trying to present your case, as far as this topic is concerned, as techniques in what in carrying out BEPS, you tell the examiner that one of the techniques of carrying out BEPS is what is thin capitalizations. If they now ask you to now explain thin capitalization, you now say thin capitalization is a what? Is a technique, it means when an organization is what is highly geared, when they are using fixed interest capital to run the what? To run the what? The company. I guess you mean now more of fixed interest capital like debentures and so on. To run the company like than equity. That means that you say the company is what is thinly capitalized. I hope I get what I'm saying. Now, how can thin capitalizations, what is the correlation of that with what? With the company not wanting to pay tax? That's BEPS. What's the relationship between what? This thin capitalization and what? And the company not wanting to pay tax. Let's connect it. When you're using debt to run a business in your SFM, if you're using debt to run a business, it means that well, you will pay interest to the what? To the supplier of fund, to the supplier of debt. Is it not? When you're paying interest is what is an allowable expense in your financial statement. I hope you still remember that. If you remember what I just said now, just say hi. There's one or two people just say hi. If you remember that interest is an allowable expense in your SFM or in your I mean the study, what you have gathered over the years. Interest is an allowable expense as against equity. I mean interest is an allowable expense. I hope you can follow. Okay, I have one person talking. That's yes. Ozoilo, Stella, Shika. Thank you, Shika. Yeah, thank you. Thank you, Antonio Altua. Thank you. Now, thank you. Now, so far you already know that interest is an allowable expense. It means that if you are highly geared, it simply means that you'll be paying more interest on that debt that you have. And if you pay more interest, that interest will eat your account. If you eat your account, it will drop your profit. And if it's dropping the profit, it's dropping the tax liability. Can you not see? If a company is having high debt, they mean the proportion of what of the debt as to dividend they're going to what to pay will be high. And that interest itself will be what? Will be netted off from the what? From the profit for the year, and tax and profit to drop and tax to drop. That's debt. But if it is equity is dividend. The return on equity is what? Is dividend. And dividend is not a liable expense. It's just paid out after tax has been paid. What's the meaning of that? It means that equity, which is debt, dividend, which is a return on equity, is not going to be allowed to reduce the tax liability. Rather, it is what? It is paid out of the profit after tax. But interest on debt will be allowed as an expense, which should be used to reduce the tax liability of the what? Of the company. Can you now see? Now, how will a multinational use this concept to reduce their tax liability? How will they use it to carry out what they call base erosion and profit shifting? Look at the way they will use it. Let's say, for instance, we use maybe MTN, for instance. MTN being a multinational company is having its activity carried out in Nigeria, and let's say it's having in Ghana also. Let's say Ghana, Nigeria, these are the where they have their operations. And they have in Zambia. Nigeria, Ghana, Zambia, they have operation in each of these countries. Now, deliberately, these multinationals can now make the Zambia divisions or the Zambia, their company in Zambia to be a financing arm of the other companies in other countries. When they say financing arm, an arm that is loaning out money, giving out funds, I guess what I'm saying now, and it's also part of the organization. Don't forget, we have in Nigeria, we have in Ghana, we have in Zimbabwe, but the one in Zimbabwe is not termed a finance arm. And what's the finance arm doing? They are releasing loan. What would they now do? They will now ask the division in Zambia to now release funds in terms of loan to the what? To the division in Nigeria. Now, it means that if they release loan, that means that more of loan they will release. Maybe let's say for instance, the one in Nigeria is going to use 100 million naira to run the business. They want to say 80 million out of the 100 million should come from Zimbabwe divisions. I guess what I'm saying now. Why in form of debt? Why the remaining 20 million will now be locally sourced in Nigeria? Now, 80 million will now be debt coming from a sister company. 20 million is now equity, which is coming from a what? Locally sourced. That simply means that multinationals, their aim will now be that when the company in Nigeria that received the loan, when he's preparing his account, the interest on that 80 million will hit the account in Nigeria as an expense. Immediately hit the account in Nigeria, the profit in Nigeria will drop, and the tax liability in Nigeria will drop. Now, at the same time, that interest again will now be moved to what? To Zambia. As it's moving to Zambia, what happened? It will be an income because it's a receipt on the investment in Nigeria. It will now be an income to them over there. And that income will now be taxed in Zambia. I hope you're getting me. Can you now see? The multinational is now using that same capitalization to move funds from Nigeria to Zimbabwe through interest. If they are doing that, they are using thin capitalization. You can see the analysis. So if you are now in the exam, if you are explaining these techniques to the examiner, you should not be telling the examiner that thin capitalization is when the company is highly geared, knowing fully well that they will be having more debt in their capital than equity, which presupposes that what? This is how you be explaining. This presupposes that what? That interest will be an allowable expense in Nigerian profit statements. But at the same time, that loan now will be seen to be coming from a financing arm from a sister company in another country, which simply means that interest paid on that loan will reduce the tax liability in Nigeria via reduction in profit, and it will also be an income into the sister company that supplied the loan, which will be an income to them and tax them, which means that one, base erosion has occurred. What's the meaning of base erosion? They have reduced profits in Nigeria through interest. Two, profit shifting have occurred because that interest now will now be received in form of income in the hands of the company in Zimbabwe. That means that they have shifted the profits in Nigeria via interest to their sister company in Zimbabwe. That means that they have successfully escaped tax in Nigeria. That is thin capitalization. I hope that is clear. Now, the third one is what? Hybrid mismatch arrangement. Hybrid mismatch arrangement. Look at the word. This is how you explain to them, because I'm expecting them that possibly they can say this in this exam. It's a new topic. Although if you enter the exam and see it's number 3, what do you do? What do you do? How do you explain it? You just have to. Now, the next one is what? Hybrid mismatch arrangement. When I say hybrid mismatch arrangement, what do I mean by that? Now, it's an arrangement in which a multinational will study the loopholes in the law of two countries in which they operate. Let's say Nigeria and South Africa. Now, they will not study the loopholes in Nigeria. They will also study the loophole in South Africa, and they have branches in the two countries. They will now identify a particular item of transactions which will affect both Nigeria and South Africa. But the way it will affect them will differ. Let's say, for instance, I'm just assuming, let's say interest now. Interest elements, like the one we explained under the thing, capitalization. Now, that interest element now, they will assume that the debt is supplied from Zimbabwe and South Africa to Nigeria. And they know that in Nigeria, if they are paying interest on the debt, that interest reduces the tax liability in Nigeria. That's one. Two, if the interest now gets to the South Africa, it will also be a tax exempt in South Africa. Listen, they will have studied these rules, tax laws of South Africa, and realize that such interest emanating from Nigeria, which have actually reduced the tax liability in Nigeria, based on South Africa rules, when it comes to South Africa, it will also not be, it should be what? You know, it's an income in South Africa now. It will not be a tax exempt income. That means that in Nigeria, it has reduced tax liability. In South Africa, it has also reduced tax liability because it is not what they did not capture it as an income. That means an item escape tax in Nigeria and also escape tax in South Africa. That concept of of escaping tax in two countries is what we call what? Double non-taxation. I guess what I'm saying now. And that is what they mean by hybrid mismatch arrangement. That simply means that they are trying to mismatch a transaction in such a way that the same transaction will be treated in Nigeria in a particular way that will make sure that they reduce or prevent tax payment, and it will be treated in another way that will make sure they did not pay tax in that other country. With that, they are good to go because it pays their company. They have manipulated the two countries' government and they will not pay tax to them. That is what they mean by hybrid mismatch arrangement. Look at this different tax rule. Look at what they put in your path. It said different tax rule between countries can sometimes give rise to unintended effects like double non-taxations, which can be exploited by businesses, like the multinationals can exploit it, by businesses to reduce their tax burden. This primarily applies to national treatment of what? Of certain instruments in such a way that they are treated in the paying country, like Nigeria that is paying it now, in the paying country as tax deductible debt. That's a liable tax debt. But seen in the receiving country, that's South Africa now, as tax exempt income. That kind of transactions, that kind of items is what they are classified under hybrid mismatch arrangement. Is a way of doing BEPS, of not wanting to pay tax in those countries. Multinational also engage in this illicit act. That's three. The last one in your package is putting assets into entity without substance. What do I mean by putting assets into entity without substance? The meaning is this. You know, like Nigerian government and South African government, obviously they will be what? They will be competing. Listen, they will be competing vigorously for what? For this foreign direct investment to come from all these foreign countries. And for them to compete, what would they do in Nigeria? Nigerian government will give out a series of of incentives. I get what I'm saying now, like pioneer incentives, accelerated capital allowance, etc. All these incentives are meant to attract these multinationals into Nigerian terrain. The same way the government in South Africa will also be drawing multinationals, drawing all these companies to their terrains, so that they will come and work, they come and carry out transactions in debt. Now let's look at Nigeria. As we Nigeria now eventually give a lot of these incentives for the purpose of attracting them. Why are they doing that? You know that if they give the incentives are meant to reduce the tax proceeds of government. I hope I get one, because if I give incentives now, like pioneer legislation incentives, is like if a company is engaging in pioneer activities, it will not pay tax in the world in the first 3 years of operations, in the first 3 years of seeking that tax incentives, and another extra 2 years based on agreement with the tax authority. That means that 5 years in question, tax will not come into government. Is it not a base erosion? That means government technically are eroding the base of in their country themselves. I guess me, why are they eroding this base to attract these multinationals? Now, why are they attracting the multinational? They believe that if the multinational comes to Nigeria, what happened? They will employ people, they will produce goods and services, they will pay tax in form of company income tax. And also, if they employ people, they will collect payee from these people. That means that this tax that the company will be paying, this payee they will be paying, will eventually go a long way to counterbalance what they are losing in terms of incentives. I guess what I'm saying now. That means at the end of the day, they will still be good to go. What they lost, they will still get it via the what? Via the payee and income tax. That is the reason why the government of this country will attract multinationals. Now, after attracting them, what about if they now attract them? They now realize that those multinationals that are grouping themselves in Nigeria now are not there for the main purpose of being productive, but they are there for the purpose of what? Of enjoying the incentives and not be productive. I guess I'm saying now. That means that our country has already lost in the sense that we are given incentives. For those companies that are given incentives, they have an ulterior motives in the sense that they will just have a fictitious company in Nigeria that they will use to siphon money out of the country, and that company will not be productive. Meanwhile, it simply means that that the tax will be expected, the productive activities that have been carried out based on what our expectation is, and also the company income tax and the pay that are supposed to have been paid will not be paid. Meanwhile, we have eroded this by giving them incentives. That's another way through which multinationals also carry out the base erosion and profit shifting, because their focus is that whatever the profit they make in Nigeria by other companies of theirs will not be taxed in Nigeria. I guess what I'm saying now, or the tax liability will reduce in Nigeria. Meanwhile, we have attracted them. We have reduced our base. I hope you're getting me. But instead of us now getting our return back, we will not be able to get it. But we have eroded our base via the incentives. That was what they explained. That's what they explained in your pack. Look at what they put there. They said putting assets into entity without substance. Look at how they put there. They said some countries introduce preferential tax regime. Like Nigeria now, we have a lot of preferential tax regime to the oil sector, to the tourism sector, and so on. Some of them are so ridiculous in the sense that they reduce the tax liability. Like I see me now. Let's look at it. Some countries introduce preferential tax regime as a way to compete for business. However, this is only useful if the business with substance. Look at this. Not a fictitious business now. It is only if that business with substance, if it will be useful if the business with substance begin to locate themselves in the country. Otherwise, this form of tax competition simply erode the tax base of the country where the activities take place. It means that if these multinationals are attracted via the incentives and are not productive, we have already eroded our base. And that is one of the ways in which multinationals gain advantage of the country. I guess what I'm saying now. These are the 4 techniques that your pack identified as carrying out the base erosion and practice and profit shifting. So after explaining all this now, then you now go ahead. And look at the second illustration. That's it. The Organization for Economic Cooperation and Development, that's OECD, is an international organization that looks into stability into all many countries in the world economically. In its efforts to address the problem associated with the base erosion and profit shifting, has issued paper on various actions against the menace of base erosion and profit shifting. Required divine base erosion. I've explained that. 2, define profit shifting. I've explained that. 3, that's it. Discuss 5 actions against base erosion and profit shifting as suggested by what? Organization for Economic Cooperation and Development. Now, what the examiner will ask under this topic is that 1, list and explain the techniques of carrying out BEPS. That's 1. 2, they will also say, list 5 recommendations by what? By the Organization for Economic Cooperation and Development against the menace of BEPS. These are what they will ask you in the exam. I'm telling you, cocktail. But there is nothing they want to ask under this topic again, unless they ask that. Let's look at those actions of the OECD. This, I need to tell you, there are a lot of things that they put in those actions, about 14 or 15 actions in your pack. Just please try to pick 5. The grammar is much fine, but try to pick 5 and know it in case they ask it in the exam. I'll pick some of them here. I will explain. I hope I get to answer now. Now, the first, according to the multinational, the OECD, they are saying one of the techniques or one of the ways of combating this menace of multinationals to BEPS is addressing of the challenges of the digital economy. You know, through digital economy, most of these multinationals carry out easily the base erosion and profit shifting. I hope I get what I'm saying now. Most of these multinationals, they leverage on digital economy. How do you want to explain this? When they say an economy is digitalized in nature, it means that most of their business transactions they use ICT to do that. That's information communication technology. To do it, if you want to send goods, you send it via what? Via online. You can do your shopping online. You know, that's technology. You can pay through online. That's technology. So if you have this kind of thing running in a country, or dominated by what? The economic activity of a country is dominated by this digital activities, it will be easier for the multinationals to transfer goods from their own countries to Nigeria and money wired to them. They are the technology also. And Nigerian government will not be able to track it. That is what their members, OECD is saying that they should address the challenges of digital economy. If you look at our new finance bill, if you go and look at the content says that the honorable minister is having the power to what? To tax a company that is not physically exposed to Nigeria, but making profit from Nigeria. In the new finance bill, he said the honorable minister is given the prerogative, is given the power to determine the level of exposure in terms of economic activities of those companies or individuals that are outside our shores, but are making money from our shores. That to an extent, if they get to an extent, the particular extent which should be set by the honorable minister, I mean, extent of the money they want exposure to the Nigerian government, the honorable minister can say from this extent forward, you have to pay tax. I get me. Because they believe that digitalized environment enables the multinational to carry out the BEPS. The second one is what? The second way, as highlighted by the OECD, is neutralizing the effect of hybrid mismatch arrangements. Because of the grammar here, let me condense it for you. If you say one of the techniques of the OECD is that they are saying that they should neutralize the effect of the hybrid mismatch. I explained to you the other time that one of the techniques of carrying out the BEPS is what? Hybrid mismatch arrangements. That is when a transaction is treated in 2 different countries in different ways, in such a way as to escape tax in these 2 countries. Now, if a transaction escape tax in Nigeria and also escape tax in US, let's assume, if we are in Nigeria and we now make our law to say, now this thing that we said it is tax allowable before, it is not tax allowable again. Is it not that we are neutralizing it? Which means that if the multinational decide to go into that kind of transaction for the sole aim of not wanting to pay tax, what will happen? They will now see our new law that is now saying that item that was little, it was a tax allowable expense before, has now been graduated to what? To non-tax allowable. I guess I said that it will not be used to reduce the tax liability again. Which means that transaction will now be taxed in Nigeria. Now, if you now get to the South Africa, they may not now tax it, but it will not be double non-taxation again. It will just be what? It will be taxed in Nigeria, but obviously not taxed in the other country. Can you imagine? With that, we have neutralized the effect of the hybrid
mismatch arrangement. Let me just quickly develop model treaty. That's a rule, provision, and recommendation regarding the design of domestic rules to neutralize the effect, e.g., double non-taxation, double deduction, long-term debarrer of hybrid instruments and entities. I guess what I'm saying now. That explains that, as simple as that they should develop a treaty that will put a transaction that were taken to be double non-taxation before. So that be a what? There will be a transaction that will not be that will not be taxed. I guess what I'm saying now. That is one of the recommendation of the OECD. That's what you explained there. The next one is wrong. Limiting base erosion via interest deduction and other financial payments. This one will attack the use of thin capitalization. You know, when we say use of thin capitalization the other time, as a technique of carrying out base erosion and profit shifting, we say if the company is thinly capitalized, there will be high interest payment, which will reduce the tax liability in that country. Then we need to limit the base erosion via interest deduction. It means that in the new finance bill also, they also stated here that the honorable minister can also determine to what extent will the company be thinly capitalized in such a way that if the company is arranging the tax affairs in such a way that what is thinly capitalized for the sole aim of taking advantage of interest deductions to reduce tax liability. They are saying the honorable minister can deliberately, I guess what I'm saying now, disregard that transactions in which the taxpayer solely gets into for the purpose of reducing the tax liability. I guess what I'm saying now. That is one of the ways our finance bill attacked this concept. Limit based erosion via interest deduction and other financial instruments. Look at what they put there. It said, develop recommendations. The one Nigerian developed in the finance business, best practices in the design of rules to prevent base erosion through the use of interest expense. For example, through the use of related party and third party debt to achieve excessive interest, like the third party debt the other time, or related debt, the one in Zimbabwe, related debt now, to achieve a reduction in tax liability, deduction, or to finance the production of exempt or deferred income, and other financial payments that are economically equivalent to interest payment. What they are saying is that we should just develop a route that will limit the base erosions. I get what I'm saying, via interest. That's they also identify. Now the next one is to counter harmful tax practices more effectively, taking into account transparency and substance. Most of the multinationals are not transparent in their activities towards the FRS. Therefore, the FRS or the tax authority should also develop a means of countering the harmful tax practices of the multinationals. I get what I'm saying. In such a way that it will make them to be transparent and to be transparent in nature. That is another OECD recommendation. That there should be a development of rules that will bring sanity into the hands of the multinationals, that they will not reduce their tax liability in the country. The next one is prevent treaty abuse. When they say you present treaty abuse, I told you the other time, the techniques of the carrying out the base erosion and profit shifting. I told you, sometimes these multinationals, they will abuse the treaty, the laws in the two countries. They know that there's a breakdown of communication between the two countries as far as the treatment of certain items. What do? They will not pick that items. You know that there is no cohesion between the two countries as per the treatment of the items. They will not lash on that item to take advantage in the two countries for the purpose of not wanting to pay tax. That is what they mean by prevent treaty abuse. OECD is now saying that the treaty abuse of what? The abuse of the treaty between two countries that is done by the multinationals should be as much as possible be prevented by ensuring that there is a reconciliation between or among countries in the world of any treaty breakdown, any breakdown in law or agreement between them, so that so a multinational will not explore it to their own advantage. Thank you for listening to this topic. That's topic 1 of take. That's base erosion and profit shifting. He's one of my banker in this exam. It's possible he did not come. It's possible the buyer did not come. It did not come. You're getting it. You should be able to what? To explain this and convince the examiner that you know what you are saying. I hope you're getting it. Please note it. The second topic is tax audit and investigation. Now, this topic is the second topic we are taking today. Tax audit and investigation. I tried to devise this. Note, we did not copy this from anywhere of the graph. In FCA, we tried to bring this advanced tax to us, so that you just get the exam and have a say, you just say through and go away. By what? By looking at this chart. So we try to use our own thinking, our own ingenuity in FCA to bring out this chart, so that I can assist our students. So that 10 minutes to the exam, after you have finished reading, if you open this chart, it should be able to assist you to passing the exam, to remember what you have read. Let's look at it. Tax audit and investigation. Let's get it. When we say tax audit and investigation, what do they mean? Let's start with tax audit. When we say you are auditing an organization, what does that mean? It simply means that what? You are trying to express opinion about that organization, whether the account they prepare, or whether the account they prepare is in tandem or is in line with what goes on in that organization for that setup, for that period under review. That means that you just want to express your opinion on the financial statement as presented by the organization, so that you will convince yourself that what they have done in that company for the period under review is the same thing with what they're presenting in the account. If you are convinced with that, you tell the shareholders the account should show and fair view of what happened. If you are not convinced, you tell the shareholders that you are putting a disclaimer, or you are not really cool with this. Right? That's audit. Let's not take it back to tax. That's audit. Let's not take it to tax audit. Now, when you now say tax audit, it simply means that it's an audit carried out by the tax authority to discover whether the accounts you submitted to them, the tax you want to submit to them, if you are a self-assessed filer, tax you said you are going to pay, the computation of capital allowance you submitted to them, all these things that you submitted in tax or when you are paying tax, when you pay tax, whether all these things are aligning with the underlying records that are used to prepare them. Again, the tax authority through tax audit want to be assured that whatever you are submitting in terms of your financial statement, in terms of the tax you are paying, in terms of all these tax you have done, in terms of tax you are paying, in terms of what on capital allowance you are computed, that they have a base or root in the underlying records used to prepare them. Because sometimes the taxpayer will not submit a financial statement, a doctored financial statement. Even the capital allowance computation will also be doctored, I guess, for their own selfish aim. At the end of the day, after doing that, they will now disclose a ridiculous amount of tax to government. That's where the government now coming through tax audits. And now peruse through your financials and what you have submitted. I get what I'm saying, and be sure, once you be sure that you have not misbehaved. That is tax audit. Look at it. Tax audit is an audit exercise meant to what? Meant to enable the tax authority to further satisfy that what? The audited financial statements and tax computations submitted by the taxpayer agree with the what? with the underlying records based on what I've explained now. So I will explain what is tax audit. Then there are two types of the tax audit the tax authority will do. The two types in the exam. This particular question came out 2 diets ago. I think 2 diets ago, yeah, or last diet. I mean, the diet before they closed down, or 2 diets ago, it came out as 20. I think it's about 20 months, maybe last diet. I hope I get what I'm saying now. Now let's look at this piece. The two types of the what of the tax audit that the government authority is doing are desk audit and field audit. Desk audit and field audit. When you say desk audit, that's the one they do in their office. When you are paying your tax, you take your tax computation, your financial statements, and the tax you are paying, you raise the check for it. Education tax and the company income tax, you can separate the check. And you now load the money into the receiving bank, get the evidence, take the evidence and all the computations and the books you carry, take it to the tax office. They will look at it. They'll give an evidence of receipt, or receipt of those documents and the payments. Then they will ask to prove. Later, they will now look into that financial statement and look at all your submissions and now call you to give an evidence or to give what evidence to support your peers in what you submitted. As they are doing that, they are doing what they call desk audit. That's the audit carried out. Tax audit carried out by the multinational, by the company, by the tax authority in their office. But the field audit is the one they will come to your office to do. I know some of you will agree with me that there are times that the multinationals, there are times there are companies, the tax authority will come to your company. They want to do their tax audit. I guess they will come there to also get their facts and be sure that you're not lying. That audit is what we call field audit. That this is what is the audit conducted at the taxpayer's business premises. Why? The desk audit is what? Is conducted in the what? In the tax office. Now, in the exam, what the examiner will ask you under this topic is that they will ask to explain what is tax audit and tax investigation. That's 1. 2, they can now ask you, what are the stages of field audits? I hope you're getting me now. That's what they will ask in this question, in this topic. I get me now. Quote me on this. There's nothing they want to come out from here. Go and look at their past question. They came out with tax investigations, steps in tax investigation. But this time around, if they ever come from it, it will obviously be tax audits. What are the steps? But before we go into the steps of tax audit, let's even look at why is tax authority looking at what? Why is tax authority? Why are they even carrying out the tax audit? Let me ask. Am I too fast, please? Just 1 or 2 people talk, please. Am I too fast? 1 minute, please. I want 1 or 2 people to solve, 1 or 2 of you to say so that we can be sure what area we are actually following, please. Okay. Ozoilo Stella said yes. Gogo Matthias said no. You think moderate? No. Okay, thank you. Okay, thank you. I just want to get a feedback so that we can I can know. Okay, so there's a mixed reactions here. Okay, Deborah said it's okay. Okay. Okay, thank you for the feedback. Appreciate. Now, the reason why we are a bit will maintain a tempo, this tempo, or because we want to see how many topics we can cover per time with you. Yes, we want to see as much because we have a limited. Your exam is close. You know what I'm saying? And you are still going to receive this audio, this video. I guess you are still going to listen over and all over again. I guess so that as much as we can, we should help you so that we can leave this advanced task. But based on the feedback, I will need to. Because of that, the lady that talked now, so I will need to just maintain the. I have to slow a bit, but I will not be too slow. So please let's follow. I pray that we are going to pass by God's grace. We are not going to repeat this advanced task by God's grace. I'm going to clear it. Now, let's go. Now, as I was saying, I explained that if they are asking a question under this field audit, under this quest topic, they are going to ask field audits. They will say, what are the steps in field audit? If you look at your path, they listed the steps there. The one they asked 2 days ago was on tax investigation. They said, list the steps of tax investigation. That was the last diet of the last syllabus. Yes. I think number 3 or 4. You can check it. Tax investigation. But this one, this tax audit. Now, if they are carrying out a tax audit, now stages in the words in the field audit now, there are about 9 to 10 stages. Let's look at the stages. I was able to shut it down. And if you check your pack, you see them there. I was just able to condense it here. Let's look at the first stage. The first stage is wrong. If the tax authority wants to come to your office to come and tax you, to come and do field audit in your company, the first thing they do, they first have to select those taxpayers that they want to carry out that audit on. That's obvious. Because if I don't even know who I'm going to carry out a tax audit on, then how will I even be able to know who am I going to meet? I guess what I'm saying now. That means that there are criteria in which the tax authority will use in selecting a taxpayer that they are going to carry out a tax audit on. Now, if the taxpayer is very, very well unlucky, they will pick him. And there is no way they pick you that you not pay additional tax. That's as in from experience. There is no way they will pick you that you not pay additional tax. You will pay. You just be praying that they should not pick you for extra field audits, but they will select you. In the exam, the first step was selection of the taxpayer to be audited. You now ask, what are those things that they look at before they select you? There are things they will look at. There are things that make them to want to select a taxpayer for tax. The first one, it can be what taxpayer with a refund claim. If you are telling the tax authorities that you are having the work, that there is a refund from them, that they are owing you, or you have a refund from them, you are a subject of what of tax audit. I guess you know from the way they do, they hardly want to return money back. They can set off, but they hardly return money back. But if you are a taxpayer that is always fond of saying the tax authority is owing you, you are a subject of what? Of a tax audit. Another reason that I can choose you is what? Taxpayer with nil returns. If you always tell them that you always make loss, are you the only one? 5 years ago, 4 years ago, you are still making losses? Even till this year, you say you make loss, you are subject to tax audit. Next one, information from intelligence. They also, in the hierarchy of tax authorities, there is a unit called intelligence unit. That unit now can also recommend a taxpayer for tax audit. Another one is what? Directives from higher government authorities. There can be directives from above that this particular company should be audited. That's also another. You can listen. They listen about 10 there. Go and pick like 5 and know the reason why they select a taxpayer. That's the first step. The second step now is what? Preliminary review of the what? Of the selected taxpayer's file. You don't need to preliminary review it because after you have selected company A for tax audit, you don't just go to their office and go and do that tax audit. You need to quickly look into their accounts and do preliminary review on their financial statement. You can even do analytical review to compare the trend, to know how the profit is moving, the expenses is moving. Even the last year they made 10 million, and this year they say they are making 1 million. Why is this so? In the previous year they made 15 million, and it now dropped to 1 million now. Why is it so? You can use ratio analysis to also look at the trend, so that you can be sure and satisfy yourself that this person is having a case with you. That is what when you say you are doing preliminary review. You know, the first step is to identify or select the taxpayer to be audited. 2, review his file. You know, they have the file in their office. You know, as you are registering for tax audits, for taxpayer, you submit your details and they will give you a TIN number. That TIN number will go with your file. They have the file over there. And that file, they will take it out and review it. That's the second step. The third one is what? Notification of taxpayer. When they identify you, when they review your file, they will now notify you. The notification is always in official letter. They will officialize the notification to you. They put in a letter and send it to you that this is what they are coming to do, and it's going to be between this period and this period. Please cooperate with us, and so on and so forth. That means that they are notified for the audit meeting. If they get to your office, they don't just go into your files. No, they will have to do a periodic meeting with you, with your finance, your CFO, and all these your relevant tasks that are involved in this work, in the running of affairs of the company. You want to have a discussion with you. In fact, when they come on that day, they will come with Atax. I guess so that you will know that they are come from FRS. When they're not having a discussion with you, they will tell you the reason why they are there. They will tell you that they are not coming to operation you. They will tell you they want your cooperation, and they also ask you to ask your questions. I guess before they go into your file. That's what they do in the periodic meeting. The next one is after they have finished with the meeting, they will now go into carrying out the field audit. They will now start looking at your books, start looking at the relevant information in your book, and so on and so forth, so that they can gather evidences regarding the fact that you are what, maybe you have not been paying tax as when due. Now, after the audit, what they do, they will now do post-audit meeting. After they have finished the audit work, they will now come again and do meeting again with you. Why are they doing that second meeting? They are doing it because they want to work, because they want to ask more information that they did not get in the book. They want to ask for your assets, where are they located, and so on and so forth. All this are what they will ask. I hope I get what I'm saying now. So that you can supply that information to them. Look at it. Post-audit meeting. This should be held immediately after the end of the field audit. After they have finished the post-audit meeting with you, they have gathered enough evidence that they want to get. They will now go to step 7. They will now do interim audit report. That means that there will be a report they will now make regarding their findings and everything regarding what they have done in your work, in your office. They will now pass that report to what? For review to headquarters. You know, they have an hierarchy. There's an headquarters of the audit, of the tax authority. They will pass that interim audit report to them. Now, if they pass it to them, what will they do? They will now look into the details of that audit, into what you have done, into what they have done. They are the one that will now make a position of how much in tax is going to be added, or additional assessment that's going to be levied on the what, or the company based on the findings are submitted to them via the report. That is a post-audit review by regional headquarter auditors. After that, then they can now reconcile. The conciliation meeting can now occur within the task of this audit workers and the companies. That reconciliation meeting will now be that this is how much you are paying next in additional. If you pay this, then we are good to go. Pay with this so time and so on and so forth. Now, at that point, the tax authority and the taxpayer can say no, that he will not pay. That will now be subject to the procedure of body of appeal commissioner, the cost of appeal, and so on and so forth. The position of contesting the assessment, the normal procedure of rejecting assessment of what levied on them will now take place on that. But if at the point of reconciliation, they agreed that they are going to pay, and they will just go ahead and make the payment. Those are the steps stages in field audit. Don't forget, the stages are: 1, they will identify the taxpayer; 2, they will review the tax files; 3, they will notify the taxpayer via official statements; 4, they will do meeting with the taxpayer before they get into your account. That's periodic meeting. 5, they will do actual audit work. 6, they will do periodic meetings so that you can get more information. 7, they will do what? They will write interim audit report. 8, they will send it up to the relevant authority, the hierarchy, so you can make information. Now, 9, they will now reconcile. That's what in the last part of we are going to exam. The last 5 minutes, look at all these charts. It will be so helpful. Thank you. They will now go into tax investigations. When they say they are investigating, it means that they are what? There is a fraud that has been committed by the taxpayer. That's when they say you are investigating. Now, the tax investigation, let's say they are investigating, there is what? Large amount of fraud have been committed. Committed fraud, evasion have occurred, by the taxpayer. Therefore, tax investigation, if the tax authority is in tax investigation, the focus of it is that they want to punish that or that taxpayer. They want to make him a case. That's what next time you not do that because of what you have done. I guess what I'm saying. So the essence of tax investigation is to drag the taxpayer to the what? To the to court and what? And go in for it. But the essence of the tax audit was to express an opinion to see whether they have shortchanged them in payment of tax and also ask for more additional tax to balance on what they are paid. But in tax investigation, in a situation where there is a fraud, and that has to be taken care of by what? By seeking redress in what? In court of law. What are the stages of this tax investigation? The stages are similar to that of tax audit, but there are little cases there because little differences there because this one is to court, and the tax audit is not to court. I get what I'm saying now, but at the initial stage, it's not to court because it goes to tribunal, even they do not agree. Now look at it, stage one. If you are doing investigation, tax investigation, what do? You do pre-investigation activities. Don't forget. When I say pre-investigation activities, what do I mean by that? I mean that if you want to go and audit a company, in the sense that you want to go and do investigation, I mean, you have to get your fact clear. Because if you don't unnecessarily accuse someone that the person is corrupt, you don't have your hard evidence. That's where the first stage here of tax investigation is a pre-investigation activity. That will be done in their office. They want to be sure, they want to get information, all information that they can get about this company. I hope I can say now. So that they want to know, like in the past, I once worked for an audit firm, and the audit firm, we had a client, and the client, day in, day out, year out, he will not pay tax, or even be money not paid. And he's making money, he's dealing with UPS. I mean, UPS, all these uninterrupted power supplies, engine machines. Now, he has been doing all these things for the past 6-7 years, and my Oga has actually been warning him, come, if these tax people come for investigation, you will go in for it too. Remember, the day they now eventually arrived, they asked him to pay one ridiculous amount. In fact, I tell you, that particular tax investigation was what led to his collapse. I guess I'm saying that for you to know that they would do, in fact, they actually told us all the transactions he has been carrying out for the past 5 years, which he did not know that his TIN number will be going alongside with the bank transactions. And he says, the tax authority now actually has to pick the PIN number and start to monitor all the transactions they have done in the past. With that, they now use it to arrive at a figure of tax liability. I think they level like maybe 20 or 30 million naira on him. Then, which was so ridiculous for him comparatively the size of his business. That is tax investigation. So they need to do pre-investigation activities. That's activities towards that precede that investigation. After doing the pre-investigation activities, what's the next thing they will now do? They will now notify him. When they are satisfied that fine, they already have a little evidence against him, they will now notify him. They are having a case against him, they will now notify him that they are coming. When they notify him at step 2, then step 3, they will now do pre-investigation meeting with you, the way you did in audit also. Do pre-investigation meeting, notify them that we are coming to do tax investigation and want your corporations. We don't want anybody to disrupt us, and so on and so forth. After they are done, they will now do evidential audits or investigation. This one we are doing is to gather evidence. You can seize any property. You can seize paper. You can go into their books. You can ask questions so that you can get your information, evidence. That's what they call evidential audit. After that, you now make a case against him in court. That you now file a case in court with those evidences you are getting, and you can now terminate the investigation. For sometimes you can decide not to go ahead with the case if you don't have a very sound or strong evidence against him. But if there is strong evidence against him, then they will go to court, and that they will be able to resolve the matter. Thank you. Now, aside this, what are the list of requirements for documents for tax audit investigation? What are the list of requirements? if the tax authority is coming to your company to come and do tax audit or investigation, they will need some requirement from you. In your path, you can check it later, but I try to pick some of those. They identify if it is FRS, what are the informations they require from you to do tax audit and investigation? They will ask for your audited accounts for the relevant years, management accounts, chart of accounts, year, the trial balance anyway, year-end trial balance, general ledger, audit adjustment voucher, and so on and so forth. Just identify 5 or 6 of them and pick it. But if it is SRS, State Inland Revenue Service, audited financial statements, general ledger or trial balance, staff list with designation, payroll of local staff and what and expatriates, schedule of company vehicle and designation, payment voucher for the period. All these are the documents that the tax authority will what SRS will what require from you. I get what I'm saying now. So what you just need to do is to identify them. I hope you're getting me. So if you look at these questions very well, I'm not going to go into the nitty-gritty of the question again because I've actually explained it. I guess, but let's look at the question they asked. The past question in that year. Look at the questions. They said, Yasal, this happens to be a past question. Yasal Limited, yeah, past question also, yeah. Yasal Limited import baby wears and has been in business for some years now. The company is doing well, very well, and the directors are impressed with the growth. The company managing director, Chief Agbai Bokinti, is a member of Enugu Sports Club. On January 14, 2015, after the morning aerobics in the club gym, a friend of Agbai Bogin, who is also the finance director of a trading outfit, narrated how the company he works for was subjected to a tax audit by the Federal Inland Revenue Service, which resulted in the payment of additional tax liability totaling over 10.5 million. Now, the finance director attributed that company's ordeal to the board's poor understanding of key tax-related issues. Chief Agbakokinti, after listening to his friends, was highly worried about such fate befalling his company. As a proactive move, he inquired for seasoned tax practitioner, and your firm, Cutting Edge and Co. Chartered Accountant, was referred to him. As the managing partner, you have to make a presentation to address the following. Don't forget, they said you have to make a presentation. If I make a presentation, I need to present it like a speech. I get it now. I know you have been taught all that in your case study. Now, you now say, hey, briefly explain what to understand by the term tax avoidance and tax evasion. Satisfy the difference between tax avoidance and tax evasion. Outline the key stages in tax audit process. Those 9 stages. Can you see the past question now of the IQ and the last syllabus? And they say state 6 objective of a tax audit exercise. You have stated it. The stages have been stated and objective are stated. The only one that I know today is the word tax audit and investigation, which I will still take care of in my incentives when I'm taking incentives. I get me what tax audit and tax avoidance and tax evasion. Avoidance simply means when the taxpayer is what is looking at the loopholes in the tax laws for the purpose of reducing his tax liability. 5, tax evasions is what is looking at is when you are contravening rules for the purpose of what of not wanting to pay tax or paying minimum amount of tax possible. Tax evasion is illegal. Tax avoidance is legal to an extent. Because if you push it further, tax avoidance further, beyond normal, they will disregard it. I hope you can saying that. That is that about the tax avoidance. And now say, what are the difference between tax avoidance and tax evasion? It's very clear. One is legal, one is illegal. Which is legal? Tax avoidance is legal. Why tax evasion is wrong? Is illegal. I get what I'm saying now? Now, the next one is achieved through the exploitation of loopholes. Tax avoidance, you did it through the exploitation of loopholes. Why achieved through deliberate action of fraud. When you say you are evading tax, you are fraudulent. You don't want to pay tax. You want to enjoy unscrupulous incentives. You want to reduce your income or increase your expenses unnecessarily. That's fraudulent in nature. 3, result in the taxpayer paying minimum tax. Possible. That's a tax avoidance. But this one results in taxpayer paying incorrect tax or paying tax through illegal means. Why the fourth one? Supported by the law court in decided case, because there are law cases that supported tax avoidance. But in no case, we have a decided cases that supported evasion. Tax avoidance, there is what? No criminal liability. For tax evasion, there is what? There is a criminal liability. That's that for that topic. Second topic. I hope you're able to pick something from there. Yeah. We soon do computations by next class. The PPT, the Pioneer, and all the CGT, insurance, and so on. All this will be taken care of. Now, quickly. We have done all this one, so we have done them, so we don't need to repeat them. Now, we're now going to the next one. Topic 3. Transfer pricing. Now, listen. The base erosion and profit shifting are expected to be false, and the transfer pricing, they are very key to this exam. Please notice, they are very key to this exam. All the topics are key, but this transfer pricing, because of the new finance bill, it addresses some of the key problems of what of the transfer pricing. That's why I said they are key. And the base erosion profit shifting is also multinational problems. It's also very key for this exam. We don't have AOC, but just do your own best. Read through. I guess I said, but don't neglect the theoreticals. You can be the saving grace in the exam. Don't say, it's PPT, it's mining, it's pioneer, and you not let all this. Because the way we look at it, whichever we look at it, is 50-50 in the exam. The theory and computation. Go and check your path. Go and check the context. If they give you PPT, they will still give you theoretical on this. I guess not to talk about that topic that are based theoretically based. So please, I'm advising us. Now let's look at transfer. When we say transfer pricing, what do you mean by transfer pricing? From our rudimentary PM. What's transfer pricing from our rudimentary PM? Transfer pricing or transfer price simply means the price at which a subunit of an organization transfer goods and services to another subunit of the same organization. Let me explain again. When you have organization 1 or organization A, organization A is having a 3 subunit under it. The subunits are subunit 1A and subunit B. Now, if A wants to now transfer goods to B, I guess what I'm saying now. At what price will A transfer goods to B in such a way that they will take cognizance that the two of them are under the same organization? I hope I guess what I'm saying. That price at which a subunit, which is A, will be transferring goods to another subunit, which is B, is said to be a transfer price. Please note, we are not in performance management class, so where you'll be doing the transfer pricing technique, the method of transfer pricing, which is opportunity cost, market demand, cost, and so on and so forth. In answer computing opportunity cost, no, we don't do all that here. There is no even computation at all. What they want from you is what are the implications of transfer pricing transactions on tax liability of what of company. That's the focus of this topic. Implications of transfer pricing technique on the what? On the tax liabilities of companies. Now, if that's the case, I've explained what's transfer pricing. Look at what they put there. They say transfer pricing is the price charged for goods or services supplied or transferred by one subunit of an organization to another subunit of the same organization. So if you are transferring between an organization, between one unit and another unit, under the same organization, you say you are what? You are doing a what? You are doing transfer price. Now, why are we doing the transfer pricing as a topic? You see, it also boils down to multinationals. They always find a way of reducing their tax liability in their host country. And how do they do that? They can use transfer pricing. Let's say, for instance, MTN. I'm not saying MTN is in transfer pricing, please. Please, I wouldn't want you to quote me an example for you to drive home, for me to drive home my point. Let's say MTF. Let's assume MTN is having a branch in Nigeria and having a branch, a division in Nigeria and a division in what? In South Africa. And it happens that all the SIMs they use in Nigeria, they are being transported into Nigeria from South Africa. Now, Nigeria, that company, MTN, may deliberately want not to pay tax in Nigeria. I get me now. What would they do? They will over-invoice that goods, that SIM, from South Africa into Nigeria. If they over-invoice it, it means that when it comes to Nigeria, the cost, it will be a cost to Nigerian division. If it's a cost to Nigerian division, what will happen? The Nigerian divisions, the cost will have risen up, and the profits will have dropped, and the tax will have dropped. Can you now see? The multinationals can use what? A transfer pricing technique to what? To reduce the tax liability in a particular country of choice. I hope I get what I'm saying. That is the implication of transfer pricing in this question. Look at this. The tax implication of this is that most multinationals use this transfer price to mischievously reduce their tax liability in a country of choice. So I've been able to explain what the transfer pricing is to you and what are the implications or reason why we are doing transfer pricing. Now, the next thing is, can you give me 1 minute, please? 1 minute, please. 1 minute. I beg you. 1 minute, please. Okay, thank you. Okay. My speaker seems mute. Thank you, Matthias. Can you hear me now?
Please go ahead, sir.
Okay, thank you. Now, let's go on. Now, okay. So let's now look at the objective. I told you, I explained the tax implication of transfer pricing. After explaining that, let us now look at the objective of regulation of what's on transfer pricing. Now, in your part, this happens to be the summary of your part. Now, in your part, they now stated it there that the Nigerian government always put up regulations. Like this new finance bill is also part of regulations. So what? To counter this harmful act of what of the multinationals through transfer pricing technique. You now ask, why is it that Nigerian government always bring up regulations against these transfer pricing techniques? You now say the objective of the what of the regulation on what on transfer pricing. What are the reasons why government have to put up a law to regulate transfer pricing? The first one is to enable Nigerian tax companies to what? To the level of their what? Is to enable Nigeria, tax companies to the level of their what of economic activities in the country. Which means that if a company is making 1 billion in Nigeria and you need to pay 300 million, then you should pay the 300 million. No? Now, it means that we should be able to tax them to the extent of their economic activity in Nigeria. That's why they are bringing out laws, because multinationals, we want to work, we want to pay tax on an amount that is even lower than what they are making normally in their business. Now, the regulation is now want to foster sanity and ensure that multinationals must ensure that they make payments they make the necessary payments based on their level of economic activity in Nigeria. That's one of the objectives. The second one is to provide FRS with tools to fight tax evasion. The multinational use this transfer pricing techniques to evade tax, so no one to pay tax. Therefore, the regulations are meant to restore what? Sanity into the system by ensuring that they provide the tools to fight tax evasion and to what? To reduce the risk of double non-taxation. Because the transfer pricing can also be used not to pay tax in another country, the country of the source, and in the country, Nigerian country, they can use this transfer pricing to what? To evade tax in these two countries on a particular transaction. The regulations will help us to what? To prevent that. So to prevent reduction in what? To reduce the risk of double. And the last one is to provide a level playing ground for multinationals, so that all the multinationals will not be preferentially treated. You'll be treated equally if you are multinationals. So that's why the regulations are in place. So in the exam, if the examiner asks you, what are the reasons for what was government legislation on what's on the transfer pricing, you should be able to tell them to provide a level playing ground. I've seen it in your past question. To provide a level playing ground, to prevent double non-taxation, to prevent evasion of tax, and to ensure that companies are taxed based on their economic exposure, economic activity in the country. Now, reason government pays attention to the transfer pricing are to prevent multinationals from using it as a tax avoidance techniques or tax evasion techniques, and to prevent custom duties and staff and tariff manipulation. Is the government normally pay attention to that area of what of the transfer pricing? Because sometimes the multinational can decide to use the transfer pricing techniques. So what? To manipulate what? To manipulate their tariff and custom duties. You know, if you are bringing anything from abroad into Nigeria, it has to pass through either the seaport or what or airport. Now, in the seaport now, there will be a Form M that will contain all the goods you are bringing in. That Form M would now be a what? Will now be what they will use, the custom will use to what? To determine your tax tariff or your custom duties of what? On the goods. If that country that's a company that is bringing in that goods now, if they want to manipulate the tax authority in Nigeria, they can over-invoice it or under-invoice it. If they over-invoice or under-invoice it, they can do any of the two for the purpose of gaining an advantage on tax payments in Nigeria, and also to prevent dividend manipulation. Sometimes the multinationals can manipulate the dividend payments. Sometimes, you know, in Nigeria now, let's say ShopRite now, Nigeria will have a seal, a cap on how much of the dividend they declare in Nigeria that they can repatriate to South Africa. That's a cap. Now, if South African company in Nigeria, if the ShopRite now say, because they want to repatriate their money, Nigeria government did not allow them to repatriate their money, they can now decide to what? To repatriate it via what? They can decide to repatriate that dividend through transfer pricing. You say I should not repatriate my dividend. Therefore, instead of repatriating that dividend, you refuse me to do that, I will increase my transfer price to the what? To the subdivision in Nigeria, which will increase the cost of what? Of that subdivision in Nigeria, and you should reduce the profit of that subdivision in Nigeria, and that subdivision in Nigeria will now need to pay that company back. You're getting me now? As they are paying, they are paying at over invoice value. That simply means that the dividend you said they should not move to the other country, they are technically moving it through the dividend payment. Therefore, to prevent the manipulation of dividend payment, that's why sometimes government looks into that direction of the transfer pricing of the multinationals. I hope you get what I'm saying now. If that's the case, what are now the method of transfer pricing? Let's look at some of the method of transfer pricing and look at what are the method we have here. Now, there is what we call COP method. They will ask, I've seen this severally in the exam. They say list and explain the different methods that is allowable by the tax authority that multinational can transfer between them. You need to pay attention to this very well. The first method is what? Controllable. The first method is what? Comparable, uncontrolled price method. What do I mean? Comparable, uncontrolled price method. That's CUP method. When we say controllable, uncontrolled price method, what do we mean? It simply means that, let's say for instance, we have two divisions. I'll be using an example. That's how you should use it for them in the example. So it can be easier. Assuming you are having two divisions, division A and division B. This, you can start noting this. You're having division A and division B. The two of them are under the same company, but the two of them are division of that company. Now, obviously there can be intercompany transfer of goods between whether A is transferring to B. Let's assume if A is transferring to B, maybe at 100 naira. Now, the tax authority will now want to see if they are using this method of comparable uncontrolled price methods. What do? They will now say, if A is transferring to B and the two of them are connected by the party, we are not sure if they are manipulating the transactions. Therefore, the tax authority will now see that assuming that transaction, assuming it's between A and the external party, that's a party that is not within the organization, what would have been the price that goods would have been transferred? If the price happens to be 80 naira, the first price between the intercompany transfers between A and B happens to be 100 naira. But if A is now transferring to the external party, assuming the price would have transferred would have been 80 naira, what will tax authority do? Tax authority will now disregard your 100 naira, the one you transfer between your party, between the division in the organization. They will now substitute it with 80 naira, which happens to be the price between the independent party. That's method of transferring, in which the tax authority will disregard the transfer price between the connected party and replace it with transfer price between the unconnected party. Is what we call comparable, uncontrolled price method. It means that comparability, you can compare the two transactions in such a way that you now pick if the one from A to your third party is the same thing with the one from A to B, then you pick it. But if it is different, you pick the one with the independent party. That is what we mean by comparable, uncontrolled price method. Now, if you want to make your decision, if you want to explain to them that if you don't have the right English to use, start telling them, assuming a company A and B are under the same organization and they are transferring at 100 naira, and you want to now see, is this 100 naira okay? That authority will now see, assuming A is transferring from to C, and C is not within the organization, and it's transferring at 80 naira, then the tax authority will now disregard the 100 naira they are transferring between themselves, and his place is 80 naira, because the 80 naira is uncontrolled, is the comparable uncontrolled price method. Now, that is the method, please. The next method is resale price method. Let's look at the resale price method. Now, when I say resale price method, what do I mean by resale price method? I mean that, listen, assuming A and B are in the same organization, this is an analysis. A and B are within the same organization, and A transfer goods to B, maybe at 100 naira, and B decided to now transfer the goods to the outsider. That's a third party that is not within the organization, which is C. At what? At 180 naira. How much did A transfer to B? Because the two of them are connected by this. He transferred it to what? At 100 naira. We want to see, is that 100 naira transfer, is it okay by the FRS? If you are using the sale price method, how will we know whether it's okay or we substitute for another thing? We now say, B transfer to C. But whenever B is transferred to C, I guess the profits on that kind of transactions, normal profit, they normally make, he has made how much profit now? Between 100 and 180. He has made 80 naira profit. Now, if he has made 80 naira profit, it means that 80 plus 100 is 180. It means that he's selling it at 180 to C. That's good. He bought it 100, he sold it 180. Now, the tax authority will now go and see that in this kind of transaction between B and C, what is the normal resale profit? What is normal profit they normally make on that transaction? If the normal profit they normally make on a transaction happens to be what? Maybe 100 naira. That means that, he has identified 80 naira as the profit. But the tax authority will now say, between independent parties or between the two parties, assuming the two are not connected, what would have been the profit they would have made on that particular transaction? If it's 100 naira, then you now say the 100 naira, remove it from the 180 they sold to SIF. It will be what? It will give you 80. Now, let's say let's say between independent party outside is 120 naira. It's 120 naira. Now look at it. A sold to B at how much? 100 naira. B sold to what? To C at how much? At 180. If B is selling to C at 180, how much profit must he have made? Must have made 80 naira. Is it enough? Is it the 80 naira he has made? The tax authority will now say, okay, so far A sold to B at 100 naira. This 100 naira now, is it the right price or not? Transfer price, is it okay? They will now go and see between B and C, what is the normal profit they normally make in that kind of transaction? Even on a normal ground, the profit they normally make is 120. That means that 120 profit now, you will now remove it from the 180 that B sold to C. If you remove it from 180, how much is remaining? 60. That means that 60 should have been the price A must have sold to B. Should have sold to B instead of what selling it at 100. They will now replace the 100 naira with a 60 naira. That method is the resale price method. If you want me to explain this again, let me know, please. If you want this to be explained again, let me know. Resale price method. Okay. Oh, okay. I will explain again now. Now, I want you to take your Bible and I want to see this analysis. A and B. Okay. Okay. Deborah, Gogo, Deborah, and Olad, Otuni, Yusuf. Yes, I'm explaining again now. Please just listen. Thank you. Now, between A and B now, between A and B are two divisions under the same organization. Now, they are connected parties. If A is selling goods to B, and he sold the goods at maybe 100 naira to B, let's assume. That's the transfer price to B. That's how much the transfer to B, but the two of them are under the same organization. Now, if B received it, B also is selling it to the outsider. B is now selling that goods to the C, but C is not within the company. It's an outside firm. I hope you understand. B will not sell what he bought at 100 naira to C at 100 naira again, because B will not want to make profit on that 100 naira. Because he has received it as 100 naira, but when he's selling it to C, he will make a profit on it. Let's say the profit he made on this, maybe the profit is maybe 50 naira. Let's assume. If the profit is 50 naira, then how much is B selling to C? Someone should tell me. If B is making 50 naira, then how much is the price B will be selling to the outsider C in that instance? Okay. Oh, thank you. 150. Which are you following? B will sell to C at 150 naira. Meaning that he made how much profit on it? 50 naira, right? Okay. Okay, thank you. Thank you, Oye, Gogo, Deborah. Thank you. Now, which means that he made how much on it? He made 15 naira on that transactions. Now, if he made 15 naira on the transaction, he sold it to C at 150. Now, the subject of contention now that will make us to know whether the 100 naira that A transfer to B is the right price or not. What will make us to know is that profit that B made on that transaction to C. Now, he made 15 naira. Now, but on a normal day, that kind of transaction, assuming it's happening between two parties outside, what would have been the profit they normally make on that transaction? If the profit they normally make on that kind of transaction is not 15 naira that B was putting on his cost, if that profit is normally 70 naira, he acknowledged 15 naira. That's why he sold it at 150. Okay. But if on a normal day, the profit on that transaction between B and C is supposed to be 70 naira. That means that 70 naira should have been the profit on it. If I now remove the 70 naira from the 150 that B sold to C, what will that give us? 150 minus 70. It would have given me how much? 80. That means that 80 should have been what A should have sold to B. Instead of 100 naira. But that 80 now will now be 80 plus 70 is not 150. I hope you get what I'm saying now. Instead of 80 plus the 50 naira profit that he was taking before, which was making it to give me 150. We now say if the profit they make on that kind of transaction outside happen to be 70 naira, not 50 naira now, then if I now go and remove that 70 naira, the normal profit from the 150 that they sold to C, how much will have been the cost to B now? It should now be 150 minus the 70 naira now, not the 50 naira now. That new profit now. 150 minus 70 naira, it will now backdate it back. It will now give you what will have been the cost from A to B. 150 minus 70 now, it will now be 80 naira. It means that instead of, it was 100 before that the A sold to B, they will now replace that 100 with what? With 80 naira. That will be the transfer price that tax authority will understand what to take cognizance of. Now, Gogo, if you understand what I just explained, let me know. Gogo, and those people that identified that they did not understand at that time. You understand? Okay, let me see. Okay, thank you. Thank you, Deborah. Understood answer. Yes, I do. Oh, understood. Okay, thank you. That's how you go and check your path. That's how they explain it. That if you cannot use your statement, this is how they use it. This is how they did it. Go and check your path. This is how they did it in their pack. Use the statement to explain. They will give you your mark. I guess that is the sale price method. Quickly. The next one is a cost plus method. The cost plus method also is like the resale price method, but there's a little difference. Look at the cost plus method. Now, if A again and B are within the same organization, and A is transferring goods to B, listen, A is transferring goods to B. Now, if is transferring goods to B at 100 naira, and to arrive at this, let's say this way. If A is transferring goods to B, how many units now? Let's say it's transferring 100 units of the goods to B. I guess what I'm saying now. And the cost of that product to A when he produces that product is 10 naira. Let's say it's 10 naira. That means that 10 times 100 units, that's 1,000. Okay? Now, assuming, listen, the profit he makes, A makes on the what? On the goods happen to be 10%. That means that what will be the price now? Can anybody tell me? What will now be the price that A must sell to B now? If 100 units are what he's selling, at 10 naira per unit, I guess what I'm saying now, and the profit percentage on it happen to be what? 10% of that 10 naira. What would be the what? What would be the what? The transfer price? I don't have a calculator here. I left my calculator somewhere else. Or let me put it this way so that I won't use calculator. Listen, just listen. If A is transferring to B, is transferring 100 units at 10 naira per unit, but the profit he makes on cost, on the cost of production, before you can transfer, maybe the profit is what? Is maybe 20 naira. Let's add 20 naira. Profit on cost. What happened? That simply means that the amount is going to transfer will now be 100 naira plus 100 naira times 10 naira per unit. Yeah? That's 1,000 naira. And the profit is what? 20 naira. That's 1,020 naira. That means that A will transfer to B how much? 1,020 naira. Yes. That's that. But if that transactions happen to be between two independent parties, not A and B now, as mean the two of them, the two parties that are involved are not connected at all. What is the normal profit they normally make on that cost? Assuming the normal profits they normally make on the cost will be maybe 40 naira. That simply means that so far the 40 naira is spent on the 20 naira profit the A was making on B, then the amount they will transfer now, according to FRS, will now be the 1,000 naira, which is 100 times 10, plus the 40 naira, which ordinarily would have been made, assuming they were independent parties. That's 1,000 hours, 40 naira. So instead of using 1,020 naira, they will now use what? 1,000 hours, 1,040 naira. That means that the profit on cost now is what the bone of contention now. If that profit on the cost is a what? Is actually different from the profit on cost that they would have made, assuming the two parties are independent parties. That means that the tax authority will reject the profit on cost. Invariably, they will reject the transfer price between A and B and now substitute it by considering the profit that they must have made between what? Two independent parties. I guess what I'm saying. So the transfer price they will now use now between A and B will now be the one that is having a function of what? Of the profit between the what? Two independent parties. Instead of it to be 1,020 now, it will now be 1,040. Now, what's the difference between resale price method and the cost plus method? The difference between them because is that The same price method is looking at it from what? A sell to B, B now sell to the outsider. What's the profit they must have made on that sales between B and outsider? But the cost plus method, that profit will be profit on the cost A is selling, not the one B is selling. I guess I said that's the major difference between the two. I guess in the profit on cost is what this cost plus method is talking about. While profit on sales is what the same price method is talking about. The last one. Before we round off. Profit split method. Now, for the profit split method, what do we mean by profit split method? This method is a method that is looking at, assuming the product they are producing is an aircraft. And the three divisions of the same organization are producing the aircraft. Maybe division A, division B, and division C. Division A is producing the engine of that aircraft. Division B is producing the body. And division C is producing the seat. Let's assume that this aircraft is produced jointly by the three divisions. Now, division A, the proportion of division A contribution to that job is 40%. Why C happens to be 30%? Why B is also 30%? Making what? 100%. 40, 30, 30. Now, you know, A will have his own cost. B will have his own cost. C will have his own cost. Now, they will now identify what is the profit they made in all. They are looking at making in the world, in the whole aircraft making. Now, that profit now is now be compared to a profit among independent parties, assuming they are independent parties. That profit among independent parties now, that profit now, assuming there are three independent parties that are not related, assume the profit they would have made on the aircraft, assuming it's happen to be 10,000 naira. That 10,000 naira now will now be shared in the proportion of the ratio of 40%, 30%, and 30% based on their contributions. We now share 4,000 to A and 3,000 to B and what? 3,000 to C. Those profits will now be added to their individual cost before. If we add the cost plus the profits shared to them, that will be the transfer price of A. For B now, if you add the profit share to him to the cost of B, that will be his transfer price of B. And for the C also will be transfer price of C. That is how they determine the transfer price under the profit split method. I hope you understand what I'm saying. So the profit split method in the exam, use the example of the aircraft to explain to the examiner. They will understand. They'll give you a full mark. That if the aircraft are produced by the three divisions under the same organization, and they have their cost, but their proportion of contribution is different. Now, we now want to see if this aircraft is produced by three independent parties, what will be the profit they will be making? If the profit is 10,000, they will now share it among the three parties in the ratio of their contribution to that aircraft. They share the profit, they will now add it to their respective costs. They now have the transfer price. That's how much they will transfer those things to the goods, to the FRS will recognize as the transfer price. That is that. So that's that for that. So please notice. So in the next one, in the next class, we'll now be talking about a very important concept here. If you check your pack, you see there. That's Advanced Pricing Agreement, APA. Advanced Pricing Agreement, APA. What is it? If examiner asks you, assuming they come from this area and say, what is the APA? You say you do not know. Oh, but they are simple. It's part of what you have to learn. APA. I will start from the next class. I really thank you for listening. Thank you. I pray that the exam will be a done deal. By God's grace, you will not repeat this paper. I guess this will be the third topic. I thought I would be able to do 4. I guess so that at least you can cover like 70% of the syllabus or 80%. Now when you get in, you are good to go. I guess. Thank you for listening. I appreciate you guys. I pray that success will be yours in this photo. If you have any question you want to ask me, direct it to the WhatsApp. Any comments, I direct it to WhatsApp. We'll try to look at it. Thank you for listening. My host, I'm done today, please. Thank you. Thank you, sir. Let me see this. Someone chatted me. Yes, I do. Thanks. I understood. Thank you too. Oh, thank you. I appreciate you guys. Thank you, sir. Thank you. Thank you. So we'll talk later, sir. Thank you, sir. You can stop the class, sir. Thank you.
Good night, sir.
Good night.